Good evening, everybody. Good. Iron Dog. Good. Good evening, Jeffrey. Welcome. Hope everybody had a fantastic weekend. Beautiful weather here in East Tennessee. Should be. Oh, sound. Good. Awesome. Cool. Yeah. Beautiful weather in East Tennessee. It's like 86 today. It's crazy. Actually got a little sun today. Oh, good. Let me know if anybody wants to talk about anything specific. I'm not really sure what the futures are doing tonight, so I can check those out. Oh, looks like they opened up around 64.50, ran up to 65, and then backed off. Looks like. So. They are down. Yeah. What's new?
Hello, sir.
Howdy.
You want to walk us through whatever we're walking through?
Sure. Just letting people, guess data on, we can start. All right. Good evening, everybody. This is Michael and Paul coming to you from Game Edge on our Sunday evening. Oh my gosh, I lost the day there. Sunday evening open mic. Hopefully it was beautiful weather wherever you were this today and this weekend. Obviously the market trend model is where we'll start with, and then Paul may take a gander at the SPX, and if we have any other questions, we'll handle those. I think basically just a quick orientation for the market trend model. It's based on the tick index. That was loud. Bolded white, no, you're good. The bolded white line is our intraday instantaneous cumulative tick. This is buying versus selling in the overall market from market participants. So obviously, if the bolded white line or CT, as we refer, is to the from upper left to lower right, or in a negative slope to the downside, there is more selling than buying in the overall market. So that's simplistic form. And obviously, if you're trying to go long any stocks, equities, ETFs, you're going to be fighting a headwind, because obviously the rest of the market is selling, and 75% of the market usually goes the direction of the overall market. And then the other orientation here are these three momentum moving averages. We refer to these as the railroad tracks. This basically is your 1 to 3 day time frame. And again, if these are in a negative slope to the downside and stacked, or what we call in reverse order or stacked order to the downside, then obviously this is indicating that there's significant selling on that 1 to 3 day time frame. And again, you would want to be either short the market or not participating in the market on the long side, and you'd be fighting the headwind, or just in a capital preservation mode, depending on what you're comfortable with your trading plan. And then the other orientation is the colored ribbon. This is our longer look back period. This is our mechanical gate to our portfolio, or to our mechanical portfolios, which are our wheel strategy, as well as our P-trans to PDX strategy. If the bolded white line is under the red or either cyan, any of those, or in the middle of the ribbon, our mechanical portfolio is turned off. Why that happens is because if the bolded white line is under this red portion, this is putting that red in a negative slope. And obviously, if we expanded this a little bit, but you can see the stair step in that red top line there, and obviously that's stair stepping down. And now, unfortunately, fortunately or unfortunately, depending on where you're positioned at, we've emerged to the downside of the colored ribbon now. So again, historically, this is an area where we can see a longer pullback or larger pullback in the overall SPX. And then the other point to make is as we stay or live, as we call, under this colored ribbon, we start to pull this red line down. And if this red line eventually crosses below the cyan, then again, that's another indication that the overall market is extremely weak, and we could have a sustained longer period of move to the downside. Again, this is not predictive, but basically this is telling you exactly what is happening in instantaneous moment from market participants. But we can leverage this information to understand that what we need for the market to turn around or bottom. And I know everybody was calling a so-called bottom. I mean, the previous couple of days, FinTwit was saying, yes, that we had hit a bottom and, we were extremes. And I don't know, the oscillators were all at negative 100 and we were going to turn around and go back to the upside. But in the essence form, we have a significant suite of tools that show us when market participants are actually starting to change their overall positioning, sentiment, as well as structure of the options market. And then the key component is the market trend model. This is telling you exactly what market participants are doing. And market participants vote with their wallet. They may talk with their mouth and we may hear lots of things, but they vote with their wallet. And if they continue to sell, then the market is going to continue to go down. That's just in the simple granularity form of what's going to occur. And then the other key takeaway up here is breadth indicator, new highs versus new lows. Obviously, as you would expect, new lows continue to outpace new highs. We actually expanded those new lows on Friday. And then this section is really what I watch, at least because I'm more of a trend follower for a longer term time frame. This is the filtered cumulative tick indicator. This is what institutions are doing, basically, or larger market participants, as this is plus 1,000, minus 1,000. These are large block orders. So understanding what is occurring in this, these are the big boys and girls that have significant amount of money positioned in the overall market. Obviously, these would be your Goldman Sachs, your JP Morgans, larger hedge funds. And if they're continuing to sell multiple days, then obviously the market is going to continue to the downside. And those would be your larger, higher beta stocks also, as those are contained in the pension funds and 401ks and how they overall, position their money. And as we said previously, we had saw the, I can scroll back here, but we saw the filtered cumulative tick really start to drop previous days. And our key takeaway was that institutions do not exit all in one day. So it started right around here on the 10th. We already started seeing multiple days, or what I like to call stacking, of filtered cumulative tick selling. And that's usually just a shot across the bow. And also the key here is you started seeing the cumulative tick really drop below those momentum moving averages. But this is usually not just a one-day event. If it's just a one-day off event, then we'll turn back and go back to the upside. But when institutions start to exit positions, they just can't exit all of their position in one day. Obviously, they have a significant amount of money invested in the market. So it's going to be a multi-day event or multi-week event, or weeks if they're trying to change their overall positioning. And we started to see that there, those 3 days stacked on. And then I believe we got a relief day. Yeah. So, but this takeaway here is this really wasn't a significant linear up day in the filtered cumulative tick. This is basically a flat day. Started up, finished week. Started up, finished week. So really, there's not accumulation going on by institutions there. And then we started back into the selling of filtered cumulative tick. So again, multi-day event, and then we expanded significantly on Friday to the downside. So if you're new to this market trend model or understanding how institutions are positioning, make sure you understand it's not going to be a one-off event. When institutions, we say turning the Titanic, it can be both directions though. Turning the Titanic to move back to the upside in the market, or turning the Titanic to move back or move to the downside and reducing their risk in the overall market. So what we look for now, let's say, hey, okay, great, Michael and Paul, what do we look for now? The first thing we would look for is the bolded white line to start moving back above these shorter term moving averages. That's the first essential thing indicating that some market participants are starting to buy more than sell. The next key takeaway is we're under this colored ribbon. This is a highly prone to what we call highly prone to failure setup that we'd be looking to short the bounces until we move above these shorter term railroad track moving averages and then emerge up outside the colored ribbon. Again, the key takeaway is this is starting to become a significant headwind as this as this red line is starting to be dragged down toward the cyan line. So all the market participants are now all moving in one direction. So it's like a tidal wave. So it's going to be very difficult to move against that tidal wave. It will happen sometime in the near future. We don't know when, but it will happen. As we've seen previously, multiple cycles in the overall market. Previously, I think it was October last year, we saw a significant move down, and then we turned the Titanic and moved back above the colored ribbon, and then everything started moving back to the upside. So, kind of a 1, 2, 3 process mechanically. The white line needs to move above the shorter term ribbon moving averages, and then we need to get above the colored ribbon, and then we need to sustain that slope to the upside in a positive slope and start stacking those days on. And then we want to see, obviously, the new highs start outpacing new lows, and institutions start to come back into accumulation mode. So in the core essence, that is the market trend model and what we need to see. As of now, it's extremely weak, and we'll be looking to short the bounces as we move back into the colored ribbon. So I think that's the takeaway. Hopefully I explained that. If anybody has any questions, if you're new to joining us, we'll cover it in the morning as I do in a pre-market prep. But it really is the core to what we do here at GameEdge. And then we move to the SPX, which is the sentiment and structure of what market participants are doing. So those 3 pillars, sentiment, structure, and trend, really are the core of what we do here at GameEdge. So, all right. Any questions? What you think, Paul? Any other color?
I think you nailed it.
Okay, good.
Yeah, the question, of course, is always, what's the market going to do? So this is a measurement of what it's been doing, and sentiment doesn't change on a dime, right? You don't go from literally a war in the Middle East to everybody saying, it's all over and now we can start rallying. If we do start rallying, what you said is spot on. We will see it. And that white line is going to be the first thing. So during the day, tomorrow, we always have some form of this, whether it's this or the MTM. I don't know if you have the Trading View MTM. I don't know if you have that available, Mike, but the takeaway is that there's lots of ways to visualize this. You can look over our shoulders at one of our screens. You can, once you join the Discord, you can download our Trading View MTM indicator, which doesn't look exactly like this, but it gives you the salient, what's the market doing, and that white line and some of the other moving averages are indicated. It keeps you in the ballpark. And then, of course, we're always talking about it every day. So there's no reason, unless you go on vacation, there's absolutely no reason to not have access to this data. I see Snow Moon shaking her hand. Welcome. And Tom's here. Harn Dog, great. Good to see you. Jeffrey, good evening. Good to see you. Thanks for making the time.
Yep. You can move to the SPX if you want to cover anything on that, or.
Yeah, I mean, everyone wants to know what the market's going to do. So, yeah, let me share my screen here and, we'll go from there. Give me a second to get over there. All right. So what are we looking at? So I can turn on all the expiries of the SPX. I can also turn on all the expiries of what just came off on Friday at the open. So what that was, Friday at the open are the AMs, right? And so GameEdge does things a little differently. We separate the AMs and the PMs because they behave completely different. Anybody out there, if you're new to looking at what we do here, anybody who doesn't separate the AMs from the PMs and you're paying for their service, you need to not pay for their service because they really don't understand what they're looking at. Just to put it in context, there's 13.1 million contracts that are associated with all of the SPX AMs. Those are the monthlies. That's where the bigger boys and girls sit. This is your institutions, as Mike said, JPM, Susquehanna, et cetera, et cetera. Everybody focuses on the monthlies, right? Doesn't mean that those players don't play with the PMs, but the PMs are really our world, right? It's kind of the retail, smaller, very nimble, a lot of hedging activity from a lot of folks, right? The big boys and girls. But as you'll see here, right, we go from 13.1 million contracts down to 3.3, all expiries. 13 million to 3 million. All right. So if you think there's not going to be a difference between the way those things play and interact, then you're at the right spot, because we can teach that. So when we look at the market, we look at the A's first, the SPX A's, and we just rolled off Friday, right? Friday's not going to be shown here because it rolled off. What we will do, though, is we tend to look at where are most of the big boys and girls concentrated. And one way we do that is we click down here in this little multicolored ribbon bar here. And you can see where, if I hover over it, I don't know if you can see it on your screen, it says select top 25% of total. So when we do that, you can see April, May, June, no July, no August. Right? It's not in the top 25. We jump immediately to September, and then we jump immediately to December. This makes perfect sense. If you understand how the institutions do what they do, they're not screwing around way out in time. They're looking at their quarterly, their monthlies, etc., and they're not really very nimble, as Mike was saying. It takes days for them to start changing their positions. And so they do this with the monthlies. We start the monthly roll a few days before it actually goes to settlement. So what is this telling us? So I haven't looked at this today, so let's look at it together. So what are we seeing? So I think the first thing that jumps off at me, right, is so when we pick what we call the upper quartile here, we get just these. And so these are the most dominant. So 71% of the entire institutional positioning in monthlies is contained in just these 5 strikes or 5 expiries. Okay, so that's kind of important. The other thing that jumps off the page at me is that they're contiguous in dates: April, May, June. So it gives us a fairly clean runway as we start looking out and asking, what are the big boys and girls doing, right? So this is not like broken in the middle, right? If I turn off, for instance, if I turn off May and turn off June because I can do it here, and jump to September, well, then there's a big gap in the middle, and volume's going to overwrite that, right? New participants, new activity from the big boys and girls are going to overwrite that. We don't have that. We have this, right? So this actually gives me confidence that I can start looking and seeing. So I'm going to turn off the September and the December. I'm just going to look at the next 3 months. We just came out of the March monthly, right? That's what settled out Friday morning, the 20th. And now let's just kind of take a look at what we got. So this gold line, spot price, closing price, last print as of Friday night. It's indicated right there, spot 65.08. So, and it's also the timestamp is just before the close there. So one of the things that jumps off to me, other than this continuity thing that I was just talking about, is that there's a lot of red on this page. Don't really need all the advanced tools to tell you that we've been selling off. There's a few things here, though, that I think are fairly significant. When we take a look at what we call net OI, and that's netting the call open interest and the put open interest together. We subtract put open interest from the call open interest. Not only in the overhead are we negative, meaning there's a lot more in the money puts up here than there are out of the money calls. We can see that just up and down the chain, with the exception of this little strike right here at 64.65, which is short interest. That's why it's negative. We adjust for known short interest. Other than that, we're negative up and down the chain. Why is that important? So as prices fall, we're going to be grabbing more negative deltas. We're going to be making our book more negative. And if we make our book more negative, it's going to force the dealer, because they're on the other side of the options trade. It's going to make them more positive. And if that occurs, they have to sell to hedge flat. So any speculation that comes to the table that forces us downward is going to be met with more selling. So volatility is high, it all starts to fit, right? It all starts coming together. So this is telling me we're not out anywhere near out of the woods. We have a thing over here called net delta. Net delta actually uses the spot price, and then it uses time to look at, when are these things going to expire? And you'll see a little bit of a difference in display, I presume, if we take a look here at the SPXP. Why I bring this part up is that if you look up and down that net delta column, you can see we are all red, right? So there's no in the money call dominance down here. This is about as bloody as we can get. That's what this is telling us. So the takeaway is across from this spot price where we are, the gold line, and with this structure, we are in a heavily put dominated area where the dealers are going to be selling as price drops, reinforcing. It's going to keep vol expanded, and that's going to keep adding fuel on the Vanna side of the equation here. So we're not out of this. So early in the week, I'm presuming, for all intents and purposes, that if we stay in this structure, and this is the SPXAs, these don't turn over fast, right? So this is an underlying foundational structure. If we stay in this structure, we're going to have literally headwinds no matter what happens. Now, there's a little asterisk on what I'm saying here. We're going to jump over to the SPXPs here in a second. The asterisk is intraday spot prices driven by market participants. There's a background pressure from this, no question about it. Charm, Vanna. If we lose, for instance, the 6,500 strike, we're going to be bringing a lot more gamma, even though it's out in time. We're going to be bringing gamma to the table, so adding negative deltas at the gamma rate. So there's definitely downside that can occur in this situation. The opposite is true too. If speculators start driving moneyness or driving spot price up, that's going to change moneyness. You can see that as we start pushing upward, we start unwinding, right? When you move through a put-dominated strike, right, you basically are undoing that negative delta that you have there. So now you're adding deltas to the table, right, by effectively removing the negative deltas. That concept's really, really important as we push around. SPXA, you're not going to see a lot of movement in volume in SPXA. Where you're going to see it, you're going to see it over here in the SPXP. So you've got this big structure, 13 million contracts out there, which is decisively bearish. That's the SPXA across the 3 months. Right? We could have sliced it. I could have just looked at the April, and we have all the tools to do that. I do that every morning for everyone. This is a little more interesting, I think, because this turns over pretty rapidly. And so if I just select tomorrow, this is what tomorrow's structure looks like. So why is this relevant in the picture of things? Well, this is what existed. So first of all, just to level the playing field, nobody in the industry gets OI updates from Opera until tomorrow morning. Nobody. Well, if you're a dealer, perhaps. But at our level, and what most of the providers are out there able to provide you, they're not going to get Opera updates. Opera doesn't start broadcasting until 4 a.m., roughly 4 a.m. Eastern time. We don't get them until 6:30. So just setting expectations. You're going to see the timestamp down here. Greeks last updated, OI updated. This will update tomorrow at 6:30. Just like it says 6:30 Friday morning, which is the way it works. But this is the structure from Friday. Okay. The Greeks are real time. The Greeks just updated at 8 o'clock. So during the weekends, we only update once an hour because why spend the money, right? There's no sense. It's just theta that you're playing with because spot price is stationary, right? Volatility, implied volatility is stationary. The only thing that's moving is time. So we update it for you so you don't have to worry about it. So this updated at 8 o'clock, a little after 8 o'clock Eastern time. What is this telling us? Well, First of all, we've got some short interest that is kind of sitting out here at 65.20. That's there, right? Okay. Known short interest can come from spreads, can come from flies, it can come from, a combination of spreads which form iron condors or all sorts of different variants on a theme, broken wings. We track all that stuff, right? You'll see, though, for the most part, the picture looks exactly the same as the SPXA. It's not really changed a lot. What has changed, though, is that we've dropped this box right here is called transition. This is our gamma transition or GEX transition. And it's dropped down because of that short interest. It's given us a little pocket in the middle of the structure. If I scroll up here, you can see very, very clearly where the net OI transitions, what we call DEX transitions. We don't have a box for that on here because it's hand drawn by us in the morning. But you can see that for all intents and purposes, when we get up to 67.15 is when we start entering into bullish territory. That's a long ways away, right? So 67.15 from the close is 3% up. Not out of the question. Not likely, though, unless we get one heck of a Vanna rally tomorrow, which is always possible, right? We can talk about that later if there's interest. But in the big picture of things, this is really, really supportive of the exact same thing that we saw in the SPXAs. So as we tend to push downward, we're going to basically make our book. We're going to capture more. Look at this. There's no calls down here. I mean, they'll fill in from Friday's activity, but the structure before Friday for Monday had no calls down here. That's why the zeros are down here, single numbers. A lot of puts, a lot of downside speculation.
Those are some big numbers on the
those are some big numbers, right?
Yeah.
This market is decisively bearish right now. And so the key takeaway is that if they continue this bearishness by forcing spot price down, and we can force spot price down by a number of things. We can close calls. There's not really a lot of calls that are short dated to close here. So that's probably not going to do anything for us, but we can open puts, right? We can take whatever monies we parked over the weekend because we didn't want to expose ourselves and now get exposed to the downside tomorrow, opening puts. That adds negative deltas to the trader's book, positive deltas to the dealers, and here we go. We start selling downward. So where are our key levels? 64.60, 64.50. We've got some things going down there. I noted this on Friday, actually. I was talking to the team in the voice Discord, and I said that looks an awful like that could be a spread. I went and checked. It's not a spread. These are just two offsetting numbers. I think one's front running the other. The 64.60 is actually running the 64.50s, right? So that's kind of an interesting development there. I'm fairly certain these are not short interest. Short interest has already been processed for the weekend. To the upside, other than this short interest that's sitting here, which is creating what we call a gamma node or a delta node sitting right here, we got a long runway of red. So if we play around in this particular area, it's just going to be chop zone. All right, so 65.50 down to 64.60, fairly weak structurally. You can look up and down here, and you don't see a lot to to push against. There might be some stuff here at 6,500, so Livermore level. It's also what we call COTMP, the cumulative out of the money put level. One of the things that's unique about Gamma Edge than other services is that each of the levels we identify has got a name. In that name, we disclose how we calculate it. So you understand what that level is. It's not just something like level 1, level 2, level 3. Why that's important is that COTMP is that level that as price starts moving down below it, we start to see increased probabilities of monetization, meaning it's where it's a balance point where now the puts that were up in this area as price transacted downward, once price gets down into this area, we're at, for the complex, close to a 50 delta on the put side. And that's where a lot of people, because they're at peak convexity, it's where they start taking things off. Certainly this bubble right here, which is called minus GEX, is the negative convexity under this OI structure for tomorrow. That is the point where most people take their contracts off the table. That's your 50 delta, right? You can leave it on. Certainly, you can leave stuff on, but there's no sense in leaving a contract on past its peak convexity. All you're doing is taking on risk for a more of a linear payoff curve. Whereas if you buy a 5 delta or a 10 delta, and then you take it off at 50, you got that whole run up, you got the whole leverage of the convexity, that gamma convexity that you played with there. So this is telling us that we could see some monetization areas starting below 6,500 and then continuing on down with a minus GEX area right down here at 6460. So I'm just, without knowing anything about tomorrow's speculation, if I were writing the game plan for tomorrow right now, I would definitely call out this area as an area that we would want to watch, and possibly could be a reversal or a stability area. It's not a wall. There's nothing about long gamma or long puts that make it a wall. It's an area of convexity peak where we start seeing monetization, and that tends as price. So think about what's happening here. Right? You got people who are speculating and they're dropping price down. Okay, they're speculating with out of the money puts. Right, they're adding negative deltas to the table. Price is dropping. Da, 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 da. All right, a lot of folks, because of the OI surface, are hitting these areas where they're at a 50 delta. They start monetizing. So you've got negative deltas going in through long puts, but then you also have closing of long puts that are at 50 delta. And you start seeing the price stabilize. It gives the appearance of a wall, has nothing to do with a wall. It has everything to do with convexity and monetization, what we call fear and greed, right? The greed is the opening of the puts to the downside. The fear is that you're going to lose your convexity, your moneyness at the 50 delta. So you close, right? It's all fear and greed. That's all this is, right? It's the structure is all that. So on the downside, it's kind of the levels I would draw. Now on the upside, 6550 isn't all that strong, right? The net OI there that is being pulled across compared to what we see over here, 2,900, 8,000, 8,000, 9,000 to the put side, 2,000 to the put side, 1,800 to the put side. And then you can see we start transitioning to the call side on strike dominance. So we are getting stretched. It's easy to see why FinTwit and the services are saying, oh, the bottom's in. It's not. Definitely not. A lot of speculation going on here. And we can see it continue. The structure is supportive to expanding vol and moving to the downside. The second part of that, which FinTwit never talks about or others never talk about, is you need the speculators to show up tomorrow to start driving spot price down. When you bring the structure and that greed component to the table, that's when you start driving price around, and that's when you can start seeing things happen. Now, if they start closing those contracts, those long put contracts, then we can see that reversal back up. Or if we start seeing calls go in, out of the money calls go in, and again, we have the tools to watch that in real time, and we do watch that in real time. So downside does seem to have somewhat of a monetization area that is visible. The upside has got a long way to go before we even get to what we call the bottom of N trans, or our negative transition zone. That's where the N trans level in our world is where the strike at which it and all the strikes below it are negative. And you can see there's a long runway here that would just overrun this positive value here. So it'll continue on down. We've got to get up to 6620 in order to even overwrite that. Now, this will update in the morning, and the morning updates that I write about will use the most current data. But I do this all the time, all hours of the day, and the continuity from one day to the other day is pretty solid. So you guys can practice doing this in the evenings. You can do it in the mornings after we get our updates. It doesn't really matter in the big picture. It's the law of large numbers. The most important thing is what Mike and I do, and that's just taking you through and making sure you know how to recognize the different levels. So just I'm scrolling up just to see where the different positive convexity levels are. 6,900, our old friend from, oh my God, just a few weeks ago. 7,000's got some stuff up there and not a lot else. So yeah, oh boy. I want to show something else here. I ran the chart while Mike was talking. I have another tool. It's called NetStat. And NetStat runs every 5 minutes in one of our automated channels. And the reason it runs every 5 minutes in our automated channels, it gives you a net status of what's happening for all the 4 Greeks. And we separate below spot price and above spot price. Why? Because that determines that your moneyness line. And as you can see in our tagline, moneyness matters, right? And it does. It really drives everything here. I want to point something out here that I think is illustrative of that we may have some charm support that is developing. We hear often that gamma provides support. Gamma doesn't provide support. Gamma is change in spot price and its impact on change in delta. Okay. If you take change in spot price out of the equation, all you get is a constant. Doesn't have really any impact on anything, right? Time never stops. Time is always there. And time right now is ticking. So we have no change in spot price. We have no change in, so gamma is effectively out of the equation right now. It's just a fixed value. There's no change in IV. So the Vanna levels that you see here are fixed in time. But we can take a snapshot in time and we can look at charm. And we have this thing over here where we have the left-hand plane that's below spot price, right? So that's all the prices, all the strikes up to and including a penny below wherever spot price is. And then above that, we have the right-hand plane, which is spot price all the way up to the top of the chain. And we aggregate that. It's called an integral, right? So we just pull out our pencils and we do a big summation. Look at this number. The units don't matter. They do matter, but they don't matter for this discussion. 196 million compared to a minus 69 million. Which is bigger? Well, 196 in absolute terms is bigger. We have deltas coming into the complex right now, right? This is the SPXP. I ran it tonight a little after 8 o'clock. It's using the 8 o'clock data, all right? Using Friday's close. 261,000 contracts, so it's relevant. It's big. What this is telling us, just as a snapshot in time, is that we're in a scenario right now where we're pushing up in the left-hand plane. What's the left-hand plane? It's below us. So it is very possible that with the structure we have now, if it is maintained after the updates tomorrow, we do have a significant amount of charm support in the left-hand plane, which is going to continue to add positive deltas to the complex. Why is that a big deal? If I make my book longer at any point in time, it makes the dealer's book shorter. And if they were previously hedged, what has to happen? They buy to hedge flat. Start putting upward prices on stuff. That's going to change spot price. It's going to basically start moving us upward off of the negative gamma convexity curve that we're on. And we're now going to start moving towards the belly and then up the positive convexity curve as these things go up. So what's the takeaway? We saw some areas down below us that potentially could provide support, monetization areas. We also have a structural setup for tomorrow where charm is imbalanced, and it's imbalanced to provide support underneath us. Here's the wild card. Look at Vanna. If volatility is higher into the open, into the morning session, we're actually favoring pouring gasoline on the fire to the downside. Vanna is more powerful, for the lack of a better way to describe it. She wields a big double-edged sword, and she cuts both ways. And what that means for us is that if volatility goes up, her influence spreads across the strike chains. If calls are coming out because of fear and puts are going into the left-hand plane where she has her dominance, her imbalance, not only are you adding more puts to the equation, you're increasing volatility as price drops. That's going to basically put more negative deltas into the book, into the trader's book, which is going to make the dealer longer, and the dealer has to sell. So watch for volatility in the morning. If VIX, here, let's just go look at it real quick. Okay, VX, the futures are up, right, from where we closed out on Friday. VIX won't start printing until about 3:15 a.m. Eastern time, so we don't have any cash market right now to look at for VIX. But the futures have gapped up, right? They closed as a relative number. This says 12%, and it looks like they opened up here at about 16. So they've opened up 4% higher. So volatility is going to be higher, and if volatility is higher for tomorrow, there's a great likelihood that we're going to add negative deltas to the book near the open. And if you add negative deltas to the book near the open, we could easily pull price down. So we could test those support levels. So what Mike and I and others do during the day, we watch NetStat, we watch the MTM, we refresh this periodically just to see what the colors are and look at the rainbows. And from there we can derive what we want to do and what side of the trade we want to be on. Any comment, Mike? Others out there listening? The chat's open. I see folks aren't really using the chat.
Yeah. No, we opened right at 64.50 actually overnight here, it looks like. So that is right at that level there. So pretty interesting.
We'll see. Oh yeah, we're at what, 64.79 equivalent right now. So
yeah, we hit 65 4 times, looks like. So
yeah.
But yeah.
Anyways, this is how I read the tea leaves. It's how a lot of folks in GE read the tea leaves. There's a lot of ways to slice the data. I try to slice it as efficiently as possible. I think, the NetStat chart is a great tool for us to use. There's some intraday tools that we have. We don't have to go into them right now. We covered them last week, I think. And you guys can go look. But I would definitely urge everyone, look at the MTM, look at the dashboard, look at NetStat, get a sense of where the transitions are, and that'll give you a sense of what potentially what the market's going to do. Yeah, that's all I got to say about that.
I agree with it.
Not too far away. It's not all I have to say. Something else just popped. You can see right here, we've got a tremendous amount of deltas in the overhead. And that makes sense. They're in the money put deltas, right? So that's why this is a big negative number right here, right? So that big negative number is the same as summing all of the net of this. So negative, right? So that's kind of cool. You look over here and it's positive for delta. Okay. Now, I suspect, because it's from spot price on down, if I scroll down, we eventually will get to a place where we start seeing in the money. Yeah, these have all limited out. There's a big contract down here in terms of deltas, 8,000. But in net, in the right-hand plane, I guess all of the call stuff that's netting out here to positive numbers is what's giving us this 184,000. Why that's important, the relative ratio here, just tells you how far down, how pounded into the ground we are. And I think that's, that's important. So we're not too far away from turning the structure what we call all put dom. That's all put dominated. In fact, we have a price right here, the 64.84 price. So if we were to lose spot price down to 64.84, right in this area, so that's not too far down actually, right? If we were to lose price down to that area, we would flip the structure to an all put dominated structure. That's an important thing. You can't, there's no more bearishness to get. It's just, when you see capitulation in the markets, when they start just panic, everyone's running for the exits. It's when you're in all put dom territory. Doesn't mean we're going to see the running for the exits if we go below 64.84. But once that happens, this will move to out of the money puts in the left-hand plane. And then it's just more negative deltas. This LHP integral will be negative at that time. You'll have nothing but negative deltas up and down. There is no call in sight. They're all in a minority. They've all been closed. Everyone's piling on puts, which are negative deltas. They're left and right, up and down. It's a free-for-all. We're not too close from that scenario. So we'll see what volatility does in the morning. 0.38 is well within the one day expected ranges right now. We're calculating at 2%. That's a crazy number. That's a crazy number. So
put your helmets on.
Your helmets and tinfoil hats on.
Yeah. Click on the 24th. It's just Jim says, can you show Tuesday? I'm going to say the OI is probably low, or So
it's 163. So but it's okay. But Mike, you did the exact right thing, right? You looked here at the total OI, and we'd like to see over 200. The SPX has a unique characteristic to it. Remember, we were talking about the SPXA, right? The monthlies. This is the SPXP, the PMs. We created our own symbols within the Gamma Edge universe. The SPXP turns over quickly. So tomorrow, somebody write this down. 261,106. 261,000. I'm going to guesstimate. We have no idea what's incoming on the updates at 6:30 in the morning. I bet you we're north of 400,000. Maybe a double of that, 2652, would be right up to 500,000, 520,000. Probably won't see that amount of addition. But what happens, and we get this question all the time. Hey, I want to swing for 5 days in the SPX. What's the perfect Gamma Edge setup? The perfect Gamma Edge setup doesn't exist when you turn over the complex due to fear and greed almost every day or every 2 days. So Jim wants to look at Tuesday. Tuesday has 163,000 contracts right now. I bet you're going to see north of 400,000 on Tuesday when Tuesday actually gets here. That's going to be over 100% change in the composition for this. So we can look at Tuesday and we can do all of the stuff that we just did, and it's valid for the information that we have. Would I bet on Tuesday and Thursdays are generally weak days? So the strongest options day of the week is Friday. You have the most total OI, and by inference, you have the most gamma presence, the most delta presence because of that. Monday comes next. Monday's number 2. The middle of the week, Wednesday, for whatever reason, the way they offered it, I don't know, whatever, is number 3. Tuesday is number 4. surprisingly. And Thursday is number 5 in strongest to weakness. So Tuesday is going to be number 4 here. I expect this number is going to change a dramatic amount. But if we take a look here, you can see where the convexity point is, right? Where minus X is, sitting down here at 6,500, strong Livermore level, psychological level, key target of the algos, on and on and on. Plus X is sitting up here at 6,530. Again, it's somewhat artificial because it was created by short interest that's sitting out there. Not strong short interest, but it's out there, right? It's going to get absorbed if it doesn't go away before then. Looking up and down the chain, these are not huge numbers. So just be cautious of the SPX and trying to project out Monday sequentially in our minds. We think of like a week, Monday, Tuesday, Wednesday. The SPX doesn't populate like that. The SPX populates Friday first, then Monday of that week, then Wednesday, then Tuesday, then Thursday. So you got to think through, where do I want to land? So for instance, just putting this in perspective, if we go out to the 27th, right? Well, even the 27th doesn't have anything. Look at that. It's virtually nothing. So we've just completely caved down off of Friday's monthly expiry. Let's look at 134 on, wow, that's kind of surprising for me. On, Thursday. Wednesday is sitting here, 171,000, 163,000, and then 261,000. And just to put it in perspective, the end of the month's already got 562 or 582,000. So, but that's kind of surprising. So the Monday following that week is only 91. So just be aware. And by the way, Jim, I know you know this, but I'm just doing it for the others. When I turn on the upper quartile, only 68% is contained in what's shown here. Normally that number's anywhere between 73 to 75, 76. So let's see what the numbers are tomorrow morning after the update and see how we've modified this and what the individual strikes are. What else? Mike? You want to talk about P2P and how there was nothing there?
Yeah, so mechanical portfolios, there's no candidates to be entering. Obviously, we wouldn't be entering anyway because our market trend model is turned off. But for us, that's also a signal that the market is obviously not bullish when there's no individual equity candidates moving above the positive transition level into a more call-dominated structure. So,
this is really
it's and expanding into the close is for me a never a good thing. I mean, so expansion we're talking about is where the bolded white line is moving further away from
diverging away. It's moving down. You can see how these things, your eye can see how they curve down, and
it's pretty significant.
That's kind of that's a dicey situation. Finished on the lows of the day, meaning we've been selling into the day. If you look back at Thursday at 3 o'clock, we actually started recovering a little bit. So that was giving people, maybe this was giving FinTwit that the bottom was in, right? We were like, hold on. Right? That's just kind of a dead cat bounce right there. And this is actually very bearish. So,
yeah, and listening to your SPX talk too, just a reminder for people that are listening to us, we'll have significant volatile rallies back to the upside that can be and most likely will be met with selling. And that's that put monetization into that area of, what Paul's showing there. I mean, we could have a significant 2% move back to the upside, but basically all that is just a put monetization relief rally. You get some Vanna tailwind. But if that is not met, I always say this in my pre-market prep, if the put monetization can only take the market so far. We have to have that out of the money call speculation. Once that rocket fuel of people closing those puts runs out, then the rocket's going to start turning back down and go back down to the other side. So that's when we know, at least from my perspective at Game Edge, where we actually might see a durable bottom when we see the put monetization. But then we actually see in the what we call right-hand plane above spot price, actually some out of the money call speculators dipping their toes in, just barely dipping their toes in. And we start seeing some of those strikes populate where you see the put OI there is just completely swamping the call OI. You'll start to see that narrow, that spread between those start to narrow a little bit. And then it'll start switching the other direction. But as of now, I mean, it is just completely put dominated. So we have to see those toe dippers start to start dipping in, but we don't see any evidence of that. And then obviously that's very clear right there that they're barely moving back towards the zero line, which is still significantly bearish. That green dotted line there.
Yeah. So just to kind of wrap up here and kind of dot the I's of what you're saying here. So this is our delta balance tool. And this is how we see if call stuff is coming into the complex, right? So it's not like people aren't trying, right? So this is the historian is what I was going to say. This is the historian of what actually transpired. And this is pointing to tomorrow's expiry. So it's pointing down. So tomorrow at the closing price from Friday, actually things aren't looking very, very good. So the green line is, like Mike said, that's the right-hand plane. So what I did is I just went down here and I just clicked in the legend just to turn the other stuff off. And I can turn prices on if you want. And typically prices fall when the right-hand plane doesn't have any calls in it or there's no call speculation. Price tends to go where there's call speculation or put speculation, right? And we've been seeing put speculation, right? So if we take a look here, I'll just turn this off here so we can see kind of what's going on. It's not been overly strong, but when this red line gets below that zero line, we have more puts starting to appear in the left-hand plane, which is the area below spot price, right? So it's not like the market wanted to just sell off, but people have been taking advantage of it. In a normal world, this red line is actually floating up because it's the left-hand plane. It's dominated by in-the-money calls. This red line is normally up here about +1, indicating strong presence of in-the-money calls and virtually no presence of out-of-the-money puts. When it's not up here at 1, that's a key that there's a lot of puts down below us, right? There's a lot of out-of-the-money speculators. Now, this is all history up until what's being projected right here for tomorrow. Looking out Tuesday, Wednesday, Thursday, Friday, because this is price sensitive, moneyness matters, right? Moneyness determines basically if something's in the money or out of the money. We're still hovering around zero. We're not seeing this like trajectory to the upside. What does it look like? Let me just go grab something here as a trajectory to the upside so you can get kind of like the aha moment with what this looks like. In fact, I'll just run it $. So these are all command line stuff that you can run in the Discord. And I'm just going to run the AMs because actually the AMs don't look all that bad month over month over month as we go out. But let me finish the story here to what Mike was saying. The green line is the forward-looking projection for the right-hand plane. It's below zero. It's not sitting on -1, so there are some out-of-the-money calls above us. So as this starts to rear its head and start trending up, we'll see it, and we can take advantage of that. We're not necessarily there. That what would be a great signal? What's it look like? It looks like this. Still not enough, but it's moneyness. Look at the shape. Look how they're all trending up as we go through time. Right? So you've got April, which is the end point here, May, June, July, August. Okay. So this is basically saying the market's forward view of delta balance in the left-hand plane and the right-hand plane increases more call concentration as we move out in time. The market believes we're not going to be hanging down here at this put, to take advantage of these puts. They're short term. Now, The blue line is an oscillator. It snaps, but it's not snapping, as you can see, because there's a lot of noise between, hey, we're going to take advantage of whatever's going on in the marketplace between puts and calls. But even it is moving up. What I like to do is I like to watch this chart. And when I start seeing that blue line get up here, I know we're starting to push upward, because that's the oscillator. It's made to snap to a +1 if we've got puts in that time frame, or calls in that time frame, or snap to the bottom side if we've got a dominance in puts. And this is telling us, for all intents and purposes, let me turn all this stuff on now. This is telling us, for all intents and purposes, -1 is about as bearish as that oscillator can get. It's not hanging out at the bottom. So it's not like saying, oh my gosh, oh my gosh, oh my gosh. But the right-hand plane is weaker from tonight's perspective. And you can see the blue is still down below 0, which is telling you it's put dominated. And it's put dominated this week at this price. So don't get too itchy on your finger to go long. Not yet. That's what this is telling me. I'm not going long. I'm short, as people know in the Discord. I'm short 6,500, and I have been for a while, and I'm loving every minute. So, all right. What do we got here? I'm catching up on stuff. Can you show Tuesday? Thanks. By looking at all of that weight spread across the week, would it suggest any rallies are most likely sold off or muted? Well, we're in a condition, Jim, where rallies, so I'm not going to go into the C10, P10, spectrum speculation that happens, but when we get up to that monetization level, so if we do rally, let's just say we do rally for whatever reason, we get up to that where the call boundary is, where people are speculating those call boundaries and they start monetizing, that's going to bring prices down. We're in a vol environment, and you saw the Vanna condition where it's heavily imbalanced on the left-hand side. So what that means, it's disproportionate in whether, if we start rallying, it's going to be muted. But if we get any more fear coming in, because the left-hand side of the net stat for Vanna was showing us that it was dominant, we get any fear coming in and volatility going up, it's just like pouring gasoline on the fire. So are the rallies most likely to get sold off under the structural conditions that you just saw in NetStat, where you've got Vanna in the left-hand plane much, much bigger than Vanna in the right-hand plane? Absolutely. Until that flips, it's going to be extremely difficult to get a Vanna rally. Extremely difficult. In fact, I will go as far as saying you can't have a Vanna rally when it's this imbalanced. This is a pretty serious imbalance. If they were even, I could edge it over to the right-hand side, kind of a coin toss type of thing. Not when it's 49 to 17. Puts and higher volatility are going to win the battle, and it's going to be dramatic. That's what that's telling us. Oh, Mike, I see you said correct. Sorry.
No, good explanation. Yep. I'll be watching this chart with the transition levels very intently. So.
Yeah, so that's 64.84. So these numbers, just so everyone is aware, and then we'll say goodbye. The transition prices in the weekend, of course, spot price isn't changing. Volatility is not changing in this calculation because we're not reading, nobody's updating options right now. So volatility is not updating. IV is not updating. So this is all fixed. If change in IV is 0, you got a constant Vanna. If change in spot price is 0, you got a constant gamma. The only thing that's changing right now is time. And if you were to run this chart every hour just to see what the difference is, you'll see the effect of time on all of these indicators, because that's the only thing that's running over the weekend. I mean, that's the way the markets work. Getting that directionality, you get a really good sense. Now, that's a geeky thing. Most people aren't going to sit here and run hourly charts on the weekend. But if you want to learn the effect of time on the different Greeks, you're going to find that Vanna and Gamma don't really care. Not when you're this far out. What matters is going to be charm. And right now, charm is supportive. That's what that 196 to 69 is telling us. But it's also telling us, Vanna's sitting here saying, not so fast, boys. She's telling us right now that if we get any volatility in here, she's going to be pretty pissed off and she's going to show it. So take advantage of it. All right, I'm out of here.
Yep.
I'll be up in, 8 hours to start working on the game plan.
Sounds good. All right.
Thanks for your time tonight, Mike.
Yeah.
Thanks, everyone. Really appreciate it.
Yeah, appreciate it. And we'll see you back here in the morning, bright and early.
You will.
All right. Thanks, everybody. Have a good evening.
You too.